The topic of today's discussion is capital structure, and while doing that we will also understand the concept of leverage and trading on equity. Now, capital structure is one of the important decisions in the financial management, which refers to financing pattern and different sources of raising finance. A business can raise its finances from various sources, and which can be broadly classified into two categories. One is owner's fund, which is referred as equity. Other is borrowed funds, referred as debt. Now, in a capital structure, we have to see mix of these two so that it is profitable to the business. Both these sources, they differ in their cost and riskiness. Now, how much in a capital we have debt and we have equity, it is also referred to as a debt equity ratio. The debt in proportion to the equity and debt in proportion to the total capital, which is total funds employed. But debt out of this is the cheaper source of finance. Why it is cheaper? Because lenders, when they lend money to the business, they are getting assured return on those funds, and there is repayment of funds at certain point of time. To the business it is cheap, plus it is a tax deductible source. While in case of equity, the dividends are paid after paying the taxes. Now, when the borrowed funds, which is also referred as debt funds, they are cheaper. A business would like to employ more debt in comparison to equity to increase the profitability of the company. But as the increase of the debt fund in the business is there is also a financial risk, and which is coming because there is a fixed obligation to pay the assured returns to the lender and also to repay the funds. If a business is not able to repay the funds in time, it is called financial risk, which can lead to the liquidation of the company. So, in the capital structure, we are trying to reach to a structure, proportion of debt and equity in a way that it results in increases earning per share of the shareholders and maximize the shareholders' wealth. So, to understand that concept, we have an example with us where we see that how with increase of the debt, the earning per share of a share is increasing, and we are also understanding a concept of leverage. Leverage is employment of debt in the total capital of the business, and when we employ debt, the earning power of the capital also increases. How it increases, that will be explained to you by the example, which is also called favorable financial leverage. So, to understand leverage, it is proportion of debt in the overall capital, and as the debt increases, cost of funds they decline, because that is the lower cost funds available to the business, and with that, the help of that low cost finances, we are trying to increase the earning power of the shares. This we will understand by this example, which gives us that total funds used in the company is 30 lakhs. So we have three scenarios. In one scenario, these 30 lakhs is used as equity capital only. In the second scenario, 10 lakhs of debt is used and 20 lakh of equity capital. And third, the 20 lakh of debt is used and only 10 lakh of equity funds is used. So interest rate is taken as 10% and tax rate as 30%. So in the first situation, when we are using 30 lakhs as equity, there is no outside debt is taken in that case. The interest will be nil. Earning before taxes will remain the same as earning before interest and taxes, that is 4 lakhs. Now this is total earning before taxes is taxed at the rate of 30%, which we have taken here. The total tax will be 1,20,000. And the earning after taxes will remain as 2,80,000 in this case, when the total funds employed in the business is by way of equity. Now this funds earned on the total number of shares is 3 lakhs, that is each share of rupees 10. Because our equity capital is 30 lakhs, each share of rupees 10 will give us number of shares here 3 lakhs, and earning per share, that means 2,80,000 divided by 3 lakhs comes to 0.93. That means every share is earning 93 paisa of profit in this case when no outside funds have been employed. In the scenario second, when we are employing 10 lakh of funds as debt and 20 lakh as equity, so our earning before interest and taxes remains the same. But in this case we are paying rupees 1 lakh as interest on 10 lakhs, which is at 10%. 10 lakhs, 10% rate of interest is cost of the funds, outside fund is 1 lakh. So the remaining profit is earning before taxes is 3 lakhs. Now these 3 lakhs we are earning and we are paying tax on these 3 lakhs, not on 4 lakhs as in the first case, because interest is also taken as tax deductible expense. That's why our interest calculation is coming less here, and the earning after tax is 2,10,000 rupees. Now these 2,10,000 rupees is to be divided among 2 lakh number of shares, not 3 lakh number of shares as earlier. So earning per share in this case comes 1.05. That means by employing debt and meeting the financial obligations of debt, that is 1 lakh, we have increased the profitability of our shares. Same scenario third is when we are employing more debt here. We are, instead of 10 lakhs, we are now employing debt of 20 lakhs. So we are paying interest of 2 lakhs here, and as these calculations are done, we are reaching to earning per share of 1.40, which shows then we are employing a cheaper source of finance in the business, which is debt here at 10%. Now there is financial leverage, we are increasing earning per share. Here the 10% is taken as cheaper source of finance because our total return on equity is 13.33%. On 30 lakhs we are earning earning before interest and taxes 4 lakhs, it is 13.33%. When the fixed cost of debt is less than that, we are increasing our earning per share. It is called trading on equity. By employing the funds which have fixed cost and which is lower than the return on investment, we are increasing earning per share. In the same manner, we can calculate a scenario where the interest rate is 15%, which is more than the ROI of a business. In that case, the scene will not be so favorable. We give you this other example to work at home, where you take the interest at 15% and make the calculation, and then we will come to the conclusion that in what cases it is more favorable. So this is all about the capital structure and trading on equity for today. Thank you.